Hi friends, today we have the second class on lesson 3 money and credit. Let's start with the loan activities of banks. We know that people keep their excess money with the banks. In other words, banks accept deposits from the public. What do banks do with this money? Banks keep only a small proportion of their deposits as cash with themselves. In India, banks hold 15% of their deposits as cash. This is kept as a provision to pay the depositors who might come to withdraw money from the bank on any given day. Major portion of the deposits of the banks is used for giving loans. So after keeping a small proportion as cash reserve, the remaining portion of deposits is given as loans. Okay. Banks mediate between those who have excess money and those who need money. The interest rate charged on loan is comparatively higher than interest rate offered to deposits. The difference in interest charged from borrowers and interest paid to depositors is the main source of income to banks. The difference between these two interest rates is known as spread, S-P-R-E-A-D, spread. This spread is the profit of banks. Okay. What will happen if all depositors ask their deposits back at the same time? This situation has emerged in many countries, including India. This situation is known as run at a bank. If there is a run at a bank, the bank will fail because they have kept only 15% of their deposits as cash. The remaining amount is given as loans. Banks fail when they ignore the main banking principles like liquidity, solvency, and profitability. You will learn about this in higher level classes. Palai Central Bank was one of the important banks failed in Kerala in 1960. In recent years also, banks have failed. 8 banks failed in India in 2015 and 5 banks in 2016. Bank failures led to the introduction of deposit insurance in 1962. Now we will discuss something about depositors and borrowers. Who are depositors? Depositors are people who deposit money with the banks. They get interest on their deposits and occasionally they withdraw money from their account. Okay. Who are borrowers? Borrowers are people who avail loans from the banks. Banks give loans from the funds deposited by other people. People who avail loan must repay it within the prescribed time with interest. Okay. A credit or loan availed for working capital may lead to two different situations. Situation 1. The borrower, Mr. X, could complete production in time and sell the product at a higher price and make a good profit. Therefore, he repays the loan in time. Okay, that is the first situation. In the second situation, the borrower could not complete production satisfactorily due to some unforeseen factors or natural calamities. His efforts were in vain. He ended in making a loss. He could not repay the loan in time. So he had to take another loan to repay the first loan. Okay. In rural areas, people mainly avail credit for crop production. They spend the amount on seeds, fertilizers, pesticides, water, electricity, etc. They repay the loan after harvest. Crop failures make the loan repayment impossible. Sometimes the farmer will be compelled to sell his land to repay the loan. This becomes a debt trap for him. Recovery from such situations is very painful. So, in one situation, we found that credit helps a person to make profit. In another situation, it pushes down a person to a debt trap. In such situations, people need some support either from the government or from the public. Now we come to the terms of credit. Interest rate, collateral security, documentation requirement, time period allowed for repayment, and the mode of repayment are together known as terms of credit. So what are the items? Interest rate, collateral security, documentation requirement, time period allowed for repayment, and the mode of repayment. All these together is known as the terms of credit. Now, what is meant by collateral? Collateral is an asset that the borrower owns and uses as a guarantee to a lender until the loan is repaid. Examples for collateral are land, buildings, vehicle, livestock, term deposit with banks, gold, etc. If the borrower fails to repay the loan, the lender has a right to sell the collateral to obtain the amount given as credit. Now let's take an example. Suppose Megha took a house loan of rupees 5 lakhs from a bank. What will be the possible terms of credit? This is just an example. Here we have to mention about the rate of interest, repayment period, equated monthly installments, mode of repayment, collateral, etc. Okay, so let us write this in this form. Rate of interest 9%, repayment period 10 years, EMI that is equated monthly installments at the rate of 8,000 rupees. Mode of repayment monthly through check. Collateral documents of the new house. Okay, this is just an example. Thank you. You can take down notes from my blog, Echo Friend. See you.